Spike reversals. In this lesson, we're going to cover one of the fastest and most deceptive price patterns you'll encounter when trading SPY, the spike reversal. A spike reversal is a sharp, aggressive move in one direction that suddenly reverses and accelerates just as quickly in the opposite direction. These moves are common during periods of high volatility and often catch traders completely off guard. The reason they're so dangerous is that they frequently trap traders who enter too early, believing they've just witnessed a strong breakout or breakdown. So, what exactly is a spike reversal? It begins with a powerful move in one direction. Price breaks through an important technical level, such as support, resistance, the opening range, or a previous day's high or low. Everything looks like a legitimate breakout, and many traders rush to enter the trade. But instead of continuing, the move suddenly loses momentum. Buyers or sellers fail to push price any further, and the breakout quickly collapses. Price reverses back through the same level and often accelerates strongly in the opposite direction. This isn't random market behavior. These reversals are often driven by institutional liquidity. Large market participants know where retail traders tend to place their stop-loss orders. By pushing price beyond key levels, they trigger those stops, create liquidity, and then reverse the market once enough orders have been filled. A typical spike reversal develops in 4 stages. First comes the impulse move, where price rapidly breaks above resistance or below support. Next comes the liquidity grab, where stop-loss orders are triggered and breakout traders enter the move. Then comes the rejection. Price is unable to hold the breakout level, and buying or selling pressure quickly fades. Finally, the reversal begins as momentum shifts and price aggressively moves back in the opposite direction. Spike reversals commonly occur around the opening range, major support and resistance levels, previous day's highs and lows, news events, and failed breakouts or breakdowns. One of the biggest mistakes traders make is chasing the initial spike because of fear of missing out. Fast price movement creates excitement, but speed alone is never confirmation. Another common mistake is entering before a rejection candle has fully formed. Waiting for confirmation may mean giving up a small portion of the move, but it greatly increases the probability that you're trading a genuine reversal instead of another fake move. It's also important to remember that not every breakout fails. Some breakouts continue higher or lower with strong momentum. That's why understanding the overall market structure and waiting for confirmation is so important. When trading spike reversals, start by identifying important technical levels before the trading session begins. Watch for fast breakouts or breakdowns near those levels, then wait for a clear rejection and evidence that market structure has shifted. Only consider entering after the reversal has been confirmed. The key lesson is that spike reversals are liquidity traps, not random price swings. Fast, vertical moves often signal exhaustion rather than strength. The traders who succeed are usually the ones who remain patient, wait for confirmation, and let the market reveal its true direction before entering the trade.